You're tuned into Mortgage Ease Unfiltered, beyond rates and real estate. Join your host, Nicole Farrugia. Get ready for real talk and actionable insights to help you succeed.
Hey everyone, Nicole Farrugia here, and welcome to another episode of Mortgage Ease Unfiltered. Today I want to just kind of talk about bracing yourself for any of your first-time homebuyers for all of the new rules that are now in effect. I feel like we've had a slew of them, but I want to kind of break down the couple sort of major ones that have been into effect over the last few weeks now. And so first things first, what I'm going to say is that these are for insured mortgages. So part of it is going to be applicable only to first-time homebuyers, while in the entirety is going to be for insured mortgages. So right off the bat, what is an insured mortgage? And the easiest way for me to explain that to you guys is essentially, if you are purchasing a property and you are putting down less than 20%, that is going to give you an insured mortgage. It's also called a high ratio mortgage. But that is basically sort of the gist of it, is that it's less than 20% down payment. And so there are going to be three insurers technically that you can have your mortgage with. And so one of the most common ones is CMHC. So sometimes even people refer to it, I have a CMHC mortgage. So it's CMHC, Sagent, and Canada Guarantee. And they are the three sort of insurers that govern all of your mortgages in Canada. And essentially how it works is that basically you are paying a premium. Actually, let me clarify that and say that the lenders are actually paying an insurance premium, and it's for default insurance. So because you're putting down less than 20%, they're considered riskier mortgages. And so the lenders are actually paying a default premium to the insurer, and the lenders are actually passing that premium back over to you guys. So that's where you're kind of paying for it. Now, right off the bat, it is not paid up front. So it's not, if you have a $20,000 premium, for example, you are not paying that up front. It is getting rolled into your mortgage. So very easy example. Let's just say your mortgage is $400,000 and random number $20,000 is your premium. Well, your mortgage is going to be $420,000 and your payments are calculated on that. So everything is rolled in, with the exception of the tax. Of course, we have tax on everything here in Canada. And so that tax, that 13% tax, for example, that will actually form part of your closing costs. So that does not get rolled into the mortgage, but the premium itself works, or gets worked in rather. And also I'll mention that the premiums are basically tiered based. So depending on how much you're putting down. So if you're putting down the very minimum, like 5%, for example, or whatever that equates to, the 5% is going to be at 4% as an insurance premium. Then it goes to 3.1 and then it goes to 2.8. And so that's kind of where that calculation will come into effect. So pros and cons of these high ratio mortgages just right off the bat. I mean, the nice thing is that in the insured space, you are going to get the best rates out there. So that's a nice thing. Sometimes when clients call me into and they're Googling rates and things like that, that's something to be mindful of, is because there is a difference between insured rates and conventional rates, for example. So you will get the best rates with the insured space. The downside to that, of course, what we just mentioned, there are additional costs to that. But for the most part, I mean, being able to get into the market versus not having to wait for that 20% is a big thing. So, pros and cons to everything. But now getting into the actual rule changes itself. So previously rather, the cap for that insured space was $1 million or 9,999. That's kind of, as soon as you hit that ceiling, you could not be in the insured space if you sort of wanted to surpass that purchase price. So back in December, now what has happened is that that cap has now been increased to $1.5 million. So, an extra $500,000 in that cap. So just to kind of give you some sort of insight into what that looks like from a down payment standpoint, because again, previously you needed 20% above $1 million. Back then it would be basically around $300,000, give or take, for that down payment on a $1.5 million property. Whereas now you're looking at about $125,000 as the minimum down payment requirement. So that's obviously, a very big change for a lot of people. But I want to emphasize where I really think that this is going to help, like who it will actually help. By no means, I'm not a big advocate of, going out and saying, like, if you're a realtor, for example, going out to your clients and say, hey, Mr. Client, now we're able to purchase several $100,000, of a larger budget. That's not what we're trying to do. That's not where I think this sweet spot for this really will be. I think it's actually more so for those clients who were, really looking at that price point in and around that 999, for example, or as a buyer in that space. You now have that wiggle room, right? So if you were in, negotiations or bidding wars or what have you, and you needed an extra $30, $40, $50,000 to kind of get you over that hump, so to speak, to be able to, get that winning offer or put forth that winning offer, you now have that wiggle room. Like now you can do that. You're not capped at that 999. So that's where I think that sweet spot will really be. And kind of, help those buyers. What the other, or the other part of it, so to speak, that is really big in this rule change is the 30-year amortization and that qualification. So actually, let me just scale back a second. So in the insured space, up until now, you only had the ability to do 25 years in the insured space. And so what is now in effect is that for first-time home buyers only. So this is the only caveat that this 30-year amortization is only applicable to first-time home buyers. So just to kind of recap, insured mortgages are available to anyone putting down less than 20%, and providing that you are living in that property. So that's kind of available to everyone across the board. And then the 30-year amortization now has specific criteria of first-time home buyer. So actually, I'll elaborate on that as well too. It's first-time home buyer or anyone that is actually purchasing pre-construction. So that's kind of the other sort of side to it, is that if you were purchasing newly constructed property, then you don't necessarily have to be a first-time home buyer. So this is where it's really important to, again, check in with me, check in with your mortgage professional or whoever you're working with, just to make sure that, if there's any, questions on this, to make sure that the, criteria is, you understand that correctly. But basically, for the first-time home buyer sort of status, for the purpose of this eligibility, we'll call it, the borrower has never purchased a property before, or in the last 4 years, they have never lived in a home that they or their common law partner has owned as well too. The other, and it kind of resets every 4 years, again, for this eligibility, as well as the fact that if you have experienced a recent separation, divorce, things like that, that could be something that could reset your first-time home buyer criteria as well too. And one of the nice things is that only one borrower for this purpose, again, has to be considered a first-time home buyer. So that's kind of really nice as well too. And so the nice thing with the 30-year amortization is that it's twofold. It's going to do two things. It is going to help increase your purchasing power. And so what I mean by that is, again, for easy numbers, let's just say that you were qualified for, $500,000 before. You will be able to qualify for a little bit more on the 30-year amortization. And that's because basically your payments now are going to be much smaller. And so with that, it just helps you qualify for a larger amount. So that's nice. It can help give buyers and first-time home buyers a little bit more stretch and wiggle room. And again, this could be the sort of make or break now for somebody to be able to get into their first home. So it'll give you a little bit of wiggle room in that. And it's also really going to help from a cash flow perspective. And so what I mean by that is that because your monthly payments now are being stretched from 25 years over to 30 years, again, that payment gets stretched out, hence it actually becomes smaller. So, you could save yourself a few $100s a month on that payment. So even if you're not looking to stretch your budget, the ability to now have, that same mortgage amount, but on a 30-year amortization is, again, going to help you with monthly sort of cash flow and, kind of put some extra money aside for savings, for example. And so, in that as well, too, I just want to clarify one thing, that with the 30-year amortization, those premiums that I discussed with you guys a little while ago, there's actually an increase to the premium for the 30 years. So this is something that I actually don't see enough information out about in social media and things like that. I've actually been seeing a lot of, posts out there that are actually, if I'm being honest, inaccurate, because they're posting, hey, this was your budget on a 25-year AM. This is your budget on a 30-year AM. And they're not factoring in the actual premiums, there's a 0.2 surcharge, we'll call it, for the 30-year amortization. So I'm seeing a lot of those numbers that are actually not accurate. So again, this is just kind of a quick reminder to give me a shout, or anybody that you're working with, just to kind of clarify those numbers. It may or may not be a big deal in terms of the overall number, but again, there is a premium for that. It's still, in almost all cases, will still make sense to typically take that 30-year amortization for most people, because it still will definitely outweigh the side of having the increased premium. But still, just to be mindful, so that I'm making sure that everybody is aware of the accurate numbers. And so, to give you some sort of perspective on that, for example, let's look at maybe an average amount of $750,000, for example, on a mortgage. So if you've got a premium of about $30,000, 4% on that, for example, so that total mortgage would be somewhere around $780,000. It's going to go from 4% to 4.2%, for example. So not a huge deal, but that's going to cost you an extra, what is that, $1,500, give or take. So just something to be mindful of as well. And so again, this is where I also want to just because I've had a lot of questions from clients or prospective clients that are just basically saying, well, Nicole, if I'm going into a 30-year amortization, does that mean more interest for me, for example, or I'm spending, a lot more time paying down my mortgage? And so my answer to that is yes or no, potentially. It will depend. And so I'm going to say hopefully not. And the reason why I'm going to say that is because the beauty of Canadian financing is that whether we have a 25-year amortization, 30-year amortization, or even longer, we have the ability to renegotiate our terms every few years. So I'm just going to use, 5 years because that's pretty standard. I know we've seen shorter terms given COVID, but on average, the standard mortgage term is 5 years. And so that just basically means that we get to renegotiate your terms every 5 years. So for example, maybe you take a 30-year amortization to start, but then, come time to renewal, maybe we're in a financial position where we're actually able to scale back and catch you up, so to speak, and take you all the way down to a 20-year amortization on your renewal if your affordability allows for that. So there's ways to catch up like that, and we can always kind of, maneuver around those things. But also, too, this is where your things like your prepayment privileges, and we'll save that for another episode to talk more about. But this is where, again, you can utilize those prepayment privileges to be able to, pay down your mortgage. And this is, again, where I cannot emphasize enough that not all products are created equal, nor are the lenders, because one lender may have 10% prepayment privileges where another one has 20%, for example. But nonetheless, this is where you can utilize those features of your mortgage to be able to pay down your mortgage. And that is going to shave off years of your amortization, or even something like an accelerated payment. And again, we'll talk about that in another episode. So those are things that you can kind of do, and just to be able to alleviate and give you the peace of mind of having a lower monthly mortgage payment. Like even myself personally, for example, every time I renew my mortgage, I actually stretch it back out to a 30-year amortization. And people would be like, you're working backwards. Why are you doing that? I personally like to have the lowest possible monthly obligation. And then I just utilize my prepayment privileges to top up my payments, throw down lump sums, all that kind of stuff. So I'm just, I like the smaller obligation, and I do what I can as I want to increase more and things like that. So I'm still catching up. I'm not, falling behind by any means. I'm actually, much more ahead of the game, but I'm just doing it at my own sort of pace and what works for me. So all in all, if, you have any questions, again, reach out to a financial professional just to kind of make sure that you're understanding some of these, rules. And again, we're always here to answer any questions. So if you have anything, reach out to me. But other than that, I think it's a wrap, guys. So thank you for lending me your ear, and stay tuned because the next episode is almost near.
Thanks for listening to Mortgage Ease Unfiltered. Hit subscribe and join us as we dive into mortgages, money, and the moments that matter. See you soon.